Hello, this is the 19th episode of What Would Peter Lynch Do? That explores the wisdom of legendary investor Peter Lynch. Investment experts all talk about the magic of compound interest in the stock market. The stock market crashes, so doesn't that mean you lose your principal? How does the magic of compound interest come about? One of our listeners asks.
Wow, that's a really excellent question. It really gets right to the heart of a fundamental puzzle in investing, doesn't it?
It really does.
You've taken this phrase, the magic of compounding, which, sounds fantastic, and you've put it right up against the very real, sometimes scary reality of market crashes.
Yeah.
And it's completely natural. I think it's wise, actually, to wonder how those two things can possibly fit together. I mean, if the market can just drop 20, 30%, how is your money actually compounding?
It feels totally backwards, doesn't it? This idea of steady, magical growth when you see these huge drops sometimes. It's like, trying to fill a bucket with holes in it.
Exactly. And that feeling, that confusion is exactly why this deep dive is so important today. Our mission, looking at the sources, is really to unpack this. We're going to try and explain exactly how compounding can work, even with market volatility, and why stocks are kind of uniquely suited for it compared to, say, bonds. And definitely we'll share some wisdom from Peter Lynch on this, too.
All right, let's dive in then. So that core question first. How is compounding even possible when markets crash? The simplest way I saw it put in our sources was this. Crashes are the process and compounding is the result.
That's a framing I really like. It sort of shifts your whole perspective, doesn't it?
Yeah.
It tells you that the bumps, the downturns, they aren't necessarily stopping the compounding. They're kind of events that happen while compounding is unfolding over the long run.
Okay.
And for that result, for the compounding to actually happen, the sources really point to two absolute must-haves. First, you need a long-term perspective. We're not talking months or even a year or two here. Think decades.
Decades, right.
And second, you need to be invested in assets that are fundamentally upward trending over that really long time frame.
So it's less about dodging the bumps and more about just staying on the road long enough in a car that's generally heading uphill.
That's a perfect way to put it, exactly. And there are really two main ways, two mechanisms in the stock market that let this compounding result happen, even with the messy process of crashes.
Okay, lay them on us. What's the first one?
So the first mechanism, it really goes back to understanding what a stock actually is. It's not just, a ticker symbol flashing on a screen.
Right.
When you buy a stock, you're buying ownership in a company, a real business.
So I own a tiny piece of, I don't know, Apple or my local energy company or whatever.
Exactly right. And what do good companies do over time? Well, they work. They make things, they offer services, they innovate, they get more efficient, and hopefully they generate profits.
Mm-hmm.
And as a company makes profits, its own value, its equity tends to grow. Think of it like a well-run shop that keeps improving, maybe expands, gets more customers. The shop itself just becomes more valuable.
Okay, so the company's actual worth is growing because it's doing business successfully.
Precisely. And over the long haul, the stock market, well, it tends to reflect that growth in the company's underlying or intrinsic value. Now, this is where the crashes come in.
Right.
A crash can happen for, all sorts of reasons. Big economic worries, sheer panic, unexpected global events. And during that crash, the price of the stock can fall, sometimes way below what the company's actually worth based on its assets and profits.
And that's when people understandably freak out.
Absolutely. It's painful watching that market price drop. But, and this is crucial from the sources, if you've invested in great companies, businesses that are solid, adaptable, and keep making money, they tend to recover. Their value holds up better, and eventually the market price catches up again and continues to reflect their growth over time. So the real compounding is happening inside the company because it's generating profits and growing. The market price might swing wildly in the short term, but over decades, it tends to follow that underlying value creation.
Okay, so the company making money and growing is the engine. The stock price is just the scoreboard, and it can be a bit erratic, but eventually it reflects the score over the long game.
That's a great way to think about it. The price swings are kind of the noise, and the company's value growth is the signal. Now, the second mechanism is maybe a bit more tangible for investors day to day. It's the snowball effect you get through reinvesting dividends.
Ah, dividends. Those are the cash payments some companies send out to their shareholders, right? Paid out of profits.
Correct. Not every company does it. Younger, fast-growing companies often reinvest all their profits back into the business to fuel more growth. But lots of established, profitable companies do pay dividends.
Okay.
And the real power, the compounding magic here, happens when you take that cash dividend and use it to buy more shares of that same company, or maybe other stocks you own.
So instead of taking the cash and spending it, you plow it right back into owning more stock.
Yes. Let's say you get $100 in dividends, you reinvest it, you buy more shares. So now you own a slightly bigger slice of the company.
Right.
Which means the next time they pay a dividend, based on your larger share count, you'll actually receive a bit more than $100.
I see.
And then you reinvest that larger amount, which buys you even more shares, and it just keeps going.
So the number of shares you own grows, and it grows faster and faster because each dividend payment buys more shares than the last one did. Like a snowball rolling downhill, picking up more snow.
Exactly. That's the perfect analogy. It just gathers mass and momentum. And here's a really interesting part that ties right back to market crashes.
Okay.
When the market crashes, stock prices are obviously much lower. So what does that mean when your dividend check arrives and you go to reinvest it?
Oh, right. If the price per share is lower, that same $100 dividend payment buys more shares than it would have when prices were high.
Precisely. Your reinvested dividend gets you more bang for your buck, acquiring significantly more ownership during the downturn. So, kind of paradoxically, these market slumps can actually be times when your reinvestment strategy is supercharged, accelerating the growth of your share count.
Wow, that is counterintuitive, but it makes total sense. The tough times are actually when the compounding snowball can grab more snow, accelerating its growth.
It does. Now, obviously, the psychology is tough, right?
Yeah, reinvesting when everyone's panicking feels wrong.
It feels very wrong.
Hmm.
But the sources really stress that if you can be disciplined about it, if you just mechanically, consistently reinvest those dividends, especially during the dips, that's a huge driver of maximizing compounding over the very long term.
Okay, so two big engines then. The company's own value growing over time, and this snowball effect of reinvesting dividends, which actually gets a boost during market downturns.
You got it. Now let's circle back to that really insightful point the listener made about how experts talk about stocks giving, say, a 7% average annual return long term. But you don't see other investments guaranteeing that.
Right. You definitely don't see a 30-year government bond or a bank CD guaranteeing 7% a year compounded for decades. That just doesn't happen.
No, it doesn't. And the source material agrees completely. Fixed returns like that just aren't realistic or guaranteed with things like deposits or bonds, mainly because interest rates fluctuate and, crucially, inflation eats away at fixed payments over time.
Mm-hmm.
But the listener did specifically ask about 30-year bonds that pay interest. You could reinvest. Can bonds do compounding that way?
Well, can they?
Yes, absolutely can. The standard way is with what's called a coupon bond. You buy the bond, and it pays you a fixed bit of interest, the coupon, usually once or twice a year. You get that cash.
Okay, so cash comes in like a dividend.
Exactly like a dividend.
Yeah.
And you, the investor, can then choose to take that cash interest payment and reinvest it. Maybe buy more bonds, maybe put it somewhere else.
Yeah.
But that act of reinvesting the income, that creates compounding.
Are there other types of bonds?
Yeah, there's also something called a zero coupon bond. These are interesting. You buy them at a big discount to their face value, and they don't pay you any interest along the way. Instead, the compounding is sort of baked in. The bond's value just gradually increases over its life until it reaches its full face value when it matures. So the return comes purely from that price appreciation.
Okay, so bonds can compound, either through reinvesting the coupons or just holding a zero coupon till maturity. But the listener's point still feels right. Stocks seem more powerful for this. Why is that, according to the sources?
Right. Even though bonds can compound, the sources point out some pretty clear limitations compared to stocks, especially when you're looking at really long time horizons like 30 years.
What are the main drawbacks for bonds?
Okay, first, for those coupon bonds, there's reinvestment risk. You get your coupon payment today, great. Let's say it was based on a 5% rate when you bought the bond years ago.
Okay.
But if interest rates in the market have fallen since then, maybe now they're only 3%, you can only reinvest that coupon in cash at the new, lower 3% rate.
Ah, so the rate you compound at isn't fixed by the original bond. It depends on current rates when you reinvest.
Exactly. Your compounding rate can actually go down if market rates fall. Second big one, maybe the biggest over 30 years, is inflation.
Right. Money losing value over time.
Hugely. Bond payments, both the coupons and the final principal you get back, are fixed dollar amounts. Over decades, inflation significantly erodes what those fixed dollars can actually buy.
That $100 coupon buys a lot less bread or gas 20 years from now.
Precisely. A bond's fixed return often struggles just to keep pace with inflation, let alone beat it substantially over the long term. Now, contrast that with owning stock in a really good company. A successful company can often raise its prices over time, right, to keep up with its own rising costs and inflation. This helps it potentially grow its profits and its intrinsic value faster than inflation. Its value isn't fixed. It can adapt.
That's a massive difference. A company's value can grow in real terms after inflation, while a bond's value is fixed and gets eaten away.
It's a critical distinction. And the third limitation is just growth limits. A bond's total return is essentially capped. Roughly the maximum you can earn the yield to maturity when you buy it.
There's a ceiling on the profit potential.
Yes. Stocks, on the other hand, while definitely riskier, they have theoretically unlimited upside. If a company truly succeeds, invents something amazing, dominates its industry, its stock price can go up 10, 20, 100 times.
Yeah.
Bonds just can't do that. That potential for exponential growth in great companies is a core part of the compounding power of stocks that bonds lack.
Okay, that really clarifies it. Bonds can compound, but stocks have this much higher potential ceiling because companies can grow beyond inflation and aren't capped at a fixed return rate. Plus, reinvesting dividends during dips adds another layer.
Exactly. And this leads right back to the listener's really smart observation. While stock investments do fall over a 30-year period, they have ultimately trended upwards. That long-term upward trend is the foundation it all rests on.
But why do stocks trend upwards over decades? Why isn't it just, flat or random bouncing around?
Well, fundamentally, it's because the stock market, in the aggregate, reflects human progress, economic growth.
Okay.
Think about it.
Yeah.
Over the long haul, societies tend to innovate, become more productive, build new businesses, solve problems, create more value overall. Despite wars, recessions, pandemics, the general trajectory of human enterprise over centuries has been upward. And the stock market, being ownership in these enterprises, it basically tracks that underlying upward path of economic growth and value creation.
So it's tied to our collective engine of progress.
In a way, yes. And the source material had a great analogy for this. Think of the market's long-term journey as a mountaineer climbing to the summit.
Okay, another analogy. I like these.
So the summit, that's the long-term upward trend, the eventual high value. But the climb isn't a smooth path, right?
Definitely not.
The mountaineer is going to trip sometimes, maybe fall down a bit. That's like a market correction.
Yeah.
They might even have to backtrack, walk downhill for a while to find a better path that's like a crash or a bear market. They could even get disoriented or lost for a time in bad weather, a prolonged downturn.
Those are the scary parts, the process parts we talked about.
Exactly. But what's the mountaineer's goal?
The summit.
Right, the summit. And as long as they don't give up, as long as they don't just turn around and go all the way back down the mountain, as long as you, the investor, stay invested, their overall altitude, their progress towards that summit keeps increasing over the long run.
So selling during a crash is like quitting the climb just because you stumbled or hit a rough patch.
Precisely. You abandon the ultimate goal because of a temporary, though maybe painful, difficulty in the process.
Right.
But if you endure, if you just keep putting one foot in front of the other, staying invested, or maybe even seize an opportunity during a dip to push harder, investing more, you'll eventually reach that higher altitude. The crashes are just part of the terrain on an ultimately upward journey.
That really clicks. The falls are part of the process, but the result is still getting higher up the mountain over time.
It really drives home the importance of persistence and perspective. Which leads us right into why so many investors, unfortunately, don't actually get the full benefit of those long-term compounding returns, even though the market generally goes up.
Why do they miss out then?
Well, very often it's because they try to predict those falls and rebounds. They try to time the market.
Trying to jump out right before the crash and then jump back in just before it takes off again.
Exactly. Sounds smart, maybe, but the evidence against it is just overwhelming. The source highlighted a really startling statistic. A huge chunk of the stock market's entire long-term gains happens on just a very small number of incredibly good trading days. If you miss just a handful of the best days over, say, 20 years, maybe the best 10 days, your final return can be drastically lower, like nearly cut in half.
Wait, missing just 10 days out of, over 5,000 trading days in 20 years can have your results? That's incredible.
It's truly stunning. And here's the kicker, the part that makes timing so dangerous.
Yeah.
those best days. They often happen right next to the worst days.
Oh.
They're frequently those really powerful rebound days that occur immediately after a big drop or during periods of intense fear and volatility.
So if you panic and sell to avoid the pain of the worst days, you are almost guaranteed to also miss the massive gains of the best days that follow right after.
That's exactly the trap. You jump out to avoid the pain, and you miss the crucial snapback that delivers so much of the long-term return. The data just screams it.
Oh.
The old saying is spot on. It's about time in the market, just being invested for the duration, not timing the market, trying to guess the zigs and zags.
Okay, that really seals the deal on the crashes are the process, compounding is the result idea. You absolutely have to be in the market through the whole messy process to capture the final result.
You really do. And this whole perspective was absolutely central to how Peter Lynch invested.
Okay, let's bring in Peter Lynch. How did he think about this? Compounding, volatility, all of it.
Well, for Peter Lynch, compounding wasn't just some abstract financial concept. It was like the ultimate reward. The prize you got for being patient, for having the insight to find great companies, and then the fortitude to stick with them through thick and thin, through their whole growth story.
So it wasn't just about buying the market. It was about finding the great businesses within it and holding on.
Absolutely. He had that famous gardening analogy he used for managing a portfolio, which really gets at this.
Right, the garden. How did that go again?
He said managing your stocks is like tending a garden. You need to be pretty ruthless about pulling out the weeds. Those are your stocks that aren't performing. The companies may be losing market share or just fundamentally struggling.
Get rid of the losers.
Yes. And then, crucially, you need to put your resources, your water, on the most beautiful, strongly blooming flowers. Those are your winners. The companies that are really firing on all cylinders, growing well.
Pull the weeds, water the flowers. Sounds simple.
Sounds simple, but he saw investors constantly doing the exact opposite. They'd get nervous about a stock that had gone up a lot of flour, and they'd sell it to lock in the profit. They'd pull the flour.
Yeah, I can see that temptation.
And then they'd look at a stock that had tanked a weed and think, oh, it's down so much it has to come back.
Yeah.
And they'd hold on to it, maybe even buy more. They keep watering the weeds.
Yeah, that hits home. You want to feel good by taking a profit, and you hate admitting you were wrong on a loser.
Exactly. And those emotional reactions completely sabotage the compounding process. For Lynch, the holy grail, the ultimate result of compounding done right, was finding a 10-bagger.
A stock that goes up 10 times your initial investment.
Right? Turning $1,000 into $10,000 or $10,000 into $100,000 from one great company, that's the kind of explosive growth compounding can deliver with the right stock over time.
Yeah.
And he knew it wasn't a smooth ride. He had this fantastic quote about it. He said, "The big money in the stock market is made in the 4th or 5th year. I often lost money for the first 3 years. But in the end, a few great companies provided enough profit to more than cover all the losses."
Wow. That's incredibly direct. He's basically saying, expect losses early on, expect volatility, but stick with your winners because a few big ones will eventually make up for everything else and then some.
Totally. It shows he understood profoundly that huge wealth comes from the long-term compounding of a few outstanding businesses, and that the gains from those winners eventually make the earlier losses or the dips in other stocks almost irrelevant. But, and this is really important, his approach wasn't just passive buy and hold forever. He stressed diligence.
So it wasn't just buy a great company and then forget about it for 10 years.
No, not at all. He said, and this is key, I like to imagine, if this company continues to do well, what will the stock price be in 2 years, in 5 years? The important thing is not to predict the future, but to periodically check and respond to whether the company is continuing its growth story.
So he wasn't trying to guess the price, but he was constantly asking, is the reason I bought this still true? Is the company still executing? Is the story still intact?
Precisely. It's about checking the fundamentals. Is this company still a flower in your garden? Is it still financially strong? Is it still innovating? Is that growth story playing out as you expected? You needed the patience to hold for years, yes, but also the diligence to keep checking that the company remained great. That continuous checking, that was essential to actually getting the compounding benefit.
Okay, so Peter Lynch's view on compounding, it's the ultimate reward, but it demands this mix of insight to find the great companies in the first place, then the patience to ride out the volatility, and finally the diligence to keep verifying that the company is still on track.
Insight, patience, diligence, applied over the long term. That's pretty much the Lynch recipe for harnessing compounding.
And now, as we wanted to do, let's say a word from Peter Lynch today and say that this principle is connected not only to investment decisions, but also to life wisdom.
Oh, absolutely. The parallels are really striking when you think about it. It's not just about stocks.
How do you see those connections playing out?
Well, take patience, for starters. Just enduring setbacks, whether it's a market crash for your investments or, a major challenge in your career, a personal failure, a really difficult patch in life. Getting through those tough periods is just part of the process, isn't it?
Yeah, you rarely get to the good stuff without going through some hardship.
Exactly. Achieving anything really meaningful long term, whether it's wealth or personal growth or success in some field, it demands pushing through that friction, that adversity.
Makes sense.
And what about focusing on value and growth? Peter Lynch's Weeds and Flowers. In life, that's like identifying what's truly valuable to you, what has real growth potential. Maybe it's investing in a key skill, nurturing important relationships, working on projects that give you purpose, and consciously choosing to put your energy there.
While actively letting go of things that drain you or hold you back the weeds in your life.
Right. Don't waste your precious time and energy watering things that aren't going anywhere or are actually detrimental.
Yeah.
And then there's Lynch's diligence. That idea of periodically checking in, asking, is this still working? Is my life growth story still on track?
Not just assuming things will work out, but actually evaluating and adapting.
Yeah, being responsive to how things are really going, rather than just sticking blindly to an old plan or trying to predict every single thing that's going to happen. That applies just as much to navigating life as it does to navigating markets.
And the long-term view, too. Realizing that the biggest rewards, life's 10 baggers perhaps, often come from sustained effort over years, even decades. A few key successes, maybe in your career or relationships or personal development, that truly compound over time can vastly outweigh lots of smaller bumps and detours.
Absolutely. Building anything worthwhile, a career, a family, expertise, wealth, it takes time. It takes getting through the tough spots, and it takes consistently focusing on and nurturing what really matters and has that potential to grow.
So when we peel it back, the magic of compounding in stocks isn't really magic at all. It's the powerful, maybe even predictable outcome of patient, diligent, long-term investment in growing businesses. And crucially, understanding that the scary parts, the crashes, are just turbulence you have to fly through to reach the destination.
And those same core principles, patience, focus on growth, diligence, long-term view, they're incredibly valuable guides for navigating life itself.
A great takeaway. Okay, building on Peter Lynch's gardening analogy one last time, here's a final thought for you, our listener, to consider today. When you look at your own investments, are you truly tending your garden, watering the flowers, pulling the weeds, or are emotions maybe causing you to do the opposite without realizing it? And perhaps more broadly, how does that principle apply to the other gardens in your life, the areas where you're trying to cultivate growth?
Definitely something worth reflecting on.
See you next time. This was What Would Peter Lynch Do? Thank you for joining us today. Have a nice day.